really interesting session today, looking at the global trends. My name's Richard Betts. For those who don't know me, I'm the publisher at Real Asset Media, and we run a series of these events, around kind of 60 over the year. We publish dailies, magazines, and of course we're also at a lot of the main events, including MIPIM Expo Real with our International Investors Lounge. Over the past year, we've introduced a lot of new initiatives. So there's Realcast, which is creating a kind of week in focus, special reports, and of course we moved all of these online, just to try and keep everybody connected. We also launched the RealX platform, an exhibition which I know there are a number of you in watching the session from there today. So welcome to everybody in RealX, and that says over 10,000 visitors since September, but actually it's over 14,000 now, I think. Really interesting discussion today. Great speakers. So speakers, if you can join me with cameras and audio, that would be great. And we'll just do some quick introductions. So let's maybe start with you, Kim. Just a kind of brief introduction of yourself and Fidelity, just so that everybody knows exactly who you are. Kim.
Yeah, I'm Kim Politzer. I'm head of European real estate research at Fidelity. We're part of a big asset management organisation, primarily investing in core markets across Europe and in the sort of core plus space.
Super, thanks very much. Simon.
Hi, I'm Simon Martin. I'm head of investment strategy at Tristan Capital Partners. We are a core plus value add and opportunistic equity investor, and also invest on behalf of our clients in real estate debt as well.
Great, thanks very much. Andrew.
Andrew Angeli, head of European Real Assets Research for CBRE Global Investors. That's the investment management arm of the US listed advisory services firm. We invest across the risk return spectrum in direct real estate, indirect, increasingly more in infrastructure, and of course debt as well.
Great, thank you. Alice.
I'm Alice Brohenny. I'm with Nuveen Real Estate. I've been with the various iterations of this firm for nearly 20 years, and in recent years managing our global research function, but always in research. My passion has often been, is around sort of secular trends rather than cyclical trends. But the last year has really sort of called into question some of those trends. So it's interesting times. So I'm really keen to hear what Nick has to say and the thoughts of this panel.
Super, thanks very much. Lee.
Hi, I'm Lee Menifee. I had the Americas research at PGIM Real Estate. PGIM Real Estate is part of the larger PGIM asset management platform, and we are active on the debt and equity side in the core and value-added space in every region in the world.
Great, thanks very much. And last but not least, Nick.
Yeah, Nick Axford. I'm Global Head of Research at Avison Young, the global real estate services firm with particular emphasis in Canada, US, UK, and Germany.
Andrew, maybe let's just start with you. I suppose out of that, what were the key takeaways that, or key things that chimed with you particularly, Andrew?
I think for me and CBRE Global Investors, we've been spending a lot of time agonizing, contemplating over what the working from home experience will mean for individuals, surely, but also for the future of the office sector. And I think we all accept that this experience has been relatively positive, but the reality is there's been little or frankly no alternative to it. And I think the deficiencies of this, remote working arrangement are now becoming more apparent. I mean, we can talk about productivity, but when I'm talking with colleagues and investors as well, they're beginning to raise real concerns whether productivity that we genuinely saw back in April, May, June is still being maintained. I also think that we've had a lot of time to really contemplate working from home. It's almost been a pet pursuit of many. We've been filling out surveys in terms of what the ideal balance of days in the office and days at home are. But I'd suggest that, filling out surveys from the comfort of home may have been somewhat aspirational. It's very easy to say what you want, but business reality will ultimately dictate our workplace preferences in the future. And I think the complexity will really occur when one organization starts to do something different than others. So the lens with which we're currently looking at the working from home experience, I fully expect will look much different once we're all vaccinated and safely able to return to the office.
Alice, maybe let's get your sense of that, particularly looking at that work from home side. How do you see that? And does that kind of chime with what Nick was saying, what Andrew's picking up there?
Yeah, I'm sort of with both of them. I thought it was a great presentation, Nick, and covering so many issues. I think the work from home one is the one that is, the jury's out on that, I think, and what it means for officers. And I think, Nick, I think you said at some point, there's a difference between what employees want and what employers want, and striking that balance is going to be really challenging. And asking people, there are so many surveys at this point in time. Now, I have not enjoyed working from home 5 days a week. Desperate to get back into the office, and that'd be my honest opinion. But if I was in the office 5 days a week and someone offered me an alternative and said you could work from home a day or two a week or choose your hours, that would be compelling as well. So I feel like until we have, the virus constrained or the vaccine, fully working, and we, the tubes is, the underground network is safe to use, we can return to offices. I don't think we'll know. And we also, and I think from an employee worker perspective, I also think that from the employer perspective, or the tenant, the occupier of the buildings, then, we need to see a sort of a full lease renewal cycle to understand actually what people's intentions. So they need to be forced to make decisions. And at the moment, there hasn't been enough evidence to really say, actually, X number of corporates have, downsized their requirements. But definitely, from what Nick says, and I'm sure everyone's agreement, more flexibility in working conditions, which means more flexibility in the kind of space that we'll be using. And the expectation that, it's sort of hospitality and experience in the workplace will be really important.
Yeah, I thought that was really interesting, that element of the office and maybe other areas as well, beginning to go through what retail had already gone through. Interesting that in the last, over the last year as well, you've been increasingly seeing more wellness coming into even areas like logistics, which had already happened in Asia, but was beginning to happen a lot more in Europe as well. Simon, just coming to you, how many of these things, I suppose, are already beginning to inform the strategy at Tristan, in terms of where, because as Nick mentions, that a lot of these have a big knock-on effect potentially for the real assets side, especially. So how much of that are you already trying to build in, or as Alice says there, is it kind of too early to call on some of these things?
I think there's sort of a number of sides to it, right? I mean, I think we have all been adapting what's going on in retail for a while now. So, I mean, we are only having been somewhat blindsided by the speed of e-commerce change there. I think a lot of portfolios, not just ours, but other people's as well, are pivoting towards other asset classes, alternatives, residential, student. Logistics is a huge piece of everybody's pie now. So there's already a pivot going on in most institutional portfolios to reflect that, and that's the same in any value-add manager's portfolio. I think the key question always comes back to the office pivot, and how to think about that. I think it's so difficult to make judgment calls in the center of a storm. And we, as Alice has said and Nick highlighted, and I think Kim mentioned it earlier on when we were chatting, you've got to really get out the other side of these to sort of erase all the behavioural and experiential biases that you may have picked up as a consequence of all of this. And I think that's the most important thing for us, is to really sort of start to look through to what the world looks like on the other side. And I think to that certain extent, Nick's bang on in terms of quality. What we're clearly seeing in our conversations with tenants who are leasing space from us is that the ESG bar across everything that we own has gone up. So there's definitely a shift to a higher standard of generalized ESG within the buildings, puts a greater emphasis on CapEx, on the capacity to fund and do the work. It makes operating partners, your platform in local markets, far, far more important to your ability to deploy and manage all of that risk. And so I think that's going to be completely critical to it. I think the other thing that we've noticed is there is a profound difference depending on the type of tenant you're interacting with and what they require from their people. So I think where we've been encountering life sciences, technology businesses looking at space, they are still very keen to focus on bringing groups of people together to collaborate in the right kind of environment. When you talk to somebody who runs a call center in a second tier city, I think they're very content that people have gone home, because ultimately, that's seen as a net perk for the worker. Although I'm somewhat skeptical if it's not just a step on the pathway to automation of their work. They have a very different reaction to what's going on in the office market. So I think a lot of what's going on in office is really going to come down to getting out of the storm and then looking really hard at the standard of accommodation and then who that accommodation serves. Because I think you're going to get a very different pattern of office occupancy from high knowledge companies in high knowledge locations than you are from low knowledge companies in cities that are right at the forefront of that kind of urbanization pull and in the war for talent. I thought the point about the war for talent is an excellent one that Nick made, and to me that's really about hot war or cold war. We've just stepped off a hot war for talent into a cold war for talent. I'm not sure that people won't start competing extraordinarily aggressively for talent again once we're out of this and back into a more normal competitive environment.
Kim, Simon mentioned there that a discussion we were having before all of the attendees joined, so we should probably just for everybody there is just pick up on that. So just come back on that Kim as well, and also in terms of Nick's presentation, what are the key things that you picked up on there? And I know you've also got some views about I guess some of the things that we should avoid thinking about, some of the kind of elephant traps in a way for us in 2021.
I think one of the things that we've been flagging up, and we've been talking quite a lot about behavioural finance and behavioural economics and how that affects the way that we think about investment for a long time. And I think this is a point in time where that thinking about our sort of habits and behaviours becomes really important when we start to think about investing, because we're in a period of enormous disruption, so we can't rely on our past experiences to play out in the future. We're also in a period where we've gone through an enormous trauma, and to be anchoring and to be putting too much weight on our immediate historic experiences could also be enormously risky. So it plays to what both Nick and Simon and Alice and Andrew have all highlighted about the office market, that our experience of working from home for the last year is not going to be typical of how we work in the future, because we will return to the offices. And I think a lot of what Nick was talking about experience, about curating space, I think is all going to be really important, particularly in those high knowledge, challenging to recruit areas for talent in particular. So I think that's a really important theme to be thinking about. But I think we do have to acknowledge that in the situation we're in, where we're working on Zoom, it's not always ideal. We risk information overload. We quite often are risking confirmation biases because we're not having those different ideas challenging us all the time that we would have in the office. So I think all of those, we need to be super aware of those things this year as we start to think about what we want to invest in and how we want to invest in it.
I just wanted to pick up with you, Lee, if I can. Obviously, they're based in the US. How much of these are trends, I guess, that are seeing globally? Is there a different perspective from the US to Europe or Asia, do you think?
There's certainly more similarities and differences across everything. And of course, the themes that Nick just covered were very much global in nature. And I guess one of the key takeaways is that despite the fact that COVID has affected different parts of the world very differently, with very different responses and very different experiences, both on the personal side and the corporate side, some of the similarities, including the lack of activity in city centers, the increasing activity outside of city centers, an increase in stated preferences for living in less dense locations. That's all playing out very evenly across the world. So I guess when I look at this and I think about the 10 themes that Nick weave together, they all do fit with one another, but some of them are in conflict. And for us, I think our most interesting work streams are resolving some of those conflicts. And the first and foremost, I guess, would be the one that I just mentioned, which would be we talk about working from home, we talk about flexibility in offices, but the question is where are those offices? There's been a many decades long trend of increasing concentration of the highest productivity industries in a few cities, mostly capital cities around the world, or in innovation sectors in a few places. And it's a rather bold call to say that's likely to reverse. And at this point, it's not our call. But that is what has happened, at least in the initial stages of the response to COVID. So we look at this and we think, our money's on mean reversion and coming back to that. But that is something that is not an entirely closed debate.
Nick, there's a question that's come in from you for you here from Marcy, which is, and I do also feel this as well, Marcy, which is, as we sit in what feels like the fifth quarter of 2020, which is very true. One question is, I believe commercial real estate professionals have a better view and understanding around thinking like an owner, regardless of their line of business, because we've all actually been living through and watching the effects of COVID on property owners. First part of that is, do you agree? And if so, which I think is a useful thing, which is, how can we use this experience to better serve all of our clients?
I sort of agree. I actually think that real estate professionals across the spectrum probably have sat and watched with great interest the debate playing out in the media, which once again characterizes anybody who owns any form of real estate as some kind of Dickensian evil landlord profiteering mercilessly from the hard sweat and toil of good, honest folk. And I think, there's a natural reaction when you see it portrayed like that to kind of side with the owners and protect them. But actually, for those of us who sit here and are actually trying to look at this, I think that's exactly what I was getting at when we were talking about the sort of the changing nature of the relationship. That's actually a ludicrous way of looking at the world, that occupiers and landlords are in this sort of Dickensian residential style battle with each other. In fact, if anything, I'd have thought nothing is further from the truth. And as real estate professionals, what I found interesting was sitting there having immense sympathy with both sides. The way landlords were being portrayed was absolutely outrageous. And the fact that has then fed through in many cases into the way in which some governments have responded, I think is a real issue. At the same time, you have to recognise that if you are a regular business operator who suddenly, through absolutely no fault of your own, is faced with having zero income or effectively zero income for an extended period, the fact that you've then got this contractual obligation to carry on paying rent for a property that you can't use, it suddenly doesn't make conventional leases appear in the best of lights. And so I think, if anything, real estate professionals are in a unique position to understand both sides of that discussion. And I have to say, in defense of the owner community and certainly our property management colleagues, they've emphasized that most sensible forward-thinking owners have been bending over backwards to find ways to work with occupiers, because taking the last 3 months of rent out of the bank of an occupier that then goes bust doesn't really do your cash flow much good. So, and investors know that. So, if anything, I think it will change the debate, hopefully, at least within real estate, if not beyond.
Okay, good. I'm going to ask both of these. Thanks very much, Vanessa, for these couple of questions. I'll ask them both, and then we can pick them up. But INREV has recently introduced a new mixed use sector category. How telling is this, and how do you see this sector contributing to portfolio performance going forward? So picking up that idea of portfolios changing. And secondly, from Vanessa, is how different is a 15-minute city to a polycentric city? Which cities already demonstrate characteristics of the 15-minute cities, and how can investors work with planners to achieve these positive attributes? So a couple of interesting questions there that have a number of points. So does anybody want to pick those up?
To jump in on the mixed use point, we've CBRE Global Investors long been proponents of mixed use assets, having really embarked on successful projects across Europe in recent years. And the reality is mixed use for us is the future, and that's because our tenants are demanding flexibility, and assets at scale typically offer the possibility of delivering that flexibility to tenants. Oftentimes, these were, historically retail-led schemes where, former managers maybe overlooked or undermanaged other parts of the center. With retail in the state that it's currently in, there's an opportunity to reimagine the space. I mean, this speaks to the whole concept of placemaking, which actually links to the whole 15-minute city. It's not a new concept. I mean, mixed-use assets have been in existence certainly across Europe, for decades, and in portfolios. But the nomenclature of an MSCI type benchmarking forces you to pick the dominant use as how the asset is identified. But we see this as a really vibrant area. And, if you look at the European Green Deal, I mean, there's some very strong and clear language of a preference for renovating existing stock. And we're doing a pretty poor job of that at a European level. Like less than 1% of stock is being renovated and repurposed on an annual basis. And that really needs to ramp up. And mixed use assets offer the scope for that. And I'd argue at offering a really attractive risk-adjusted return.
And Alice, you wanted to come in on that as well.
Oh yeah, no, I mean, just to reiterate and agree with what Andrew said, and it's reassuring that INREV have come up with a definition of mixed use, or they're assigning it as a sector. And my view for a long time has been that the most compelling pieces of real estate, the most relevant pieces of real estate, wouldn't fit neatly into a bucket that says retail or office or residential. They'd have a combination of both, and they'll be relevant because they're flexible to perhaps upweight retail when it's relevant, downweight. And I think mixed use gives you the real opportunity to put your clients' money away in a sort of a meaningful way. It talks to the theme of impact, which I think is really important and something that occupiers and investors will want. And quite often, successful mixed use schemes, they have sort of real benefits. They really benefit from adjacencies to perhaps infrastructure, waterfront, something that is of historical interest. And often, if you look at those that have done well, so I think I think the investors' mindset has switched from maybe 5 to 10 years ago, thinking, oh well, the fact that it's mixed use, I want a discount on it, to actually now paying a premium because it has that mixed use. And I think it also talks to the second piece of the question, which I don't feel qualified to answer, but about the 15-minute city. But it is about the mixed use idea, is that people don't want to make separate journeys to live, work, shop, play, gym, mindfulness. And the more that they can combine those journeys, and it's all about efficiency and maximizing the use of your time. And I think that's why mixed use works. And probably cities that embrace that, and they probably are the 15-minute cities, will do well as well.
And Simon, you wanted to come in.
Yeah, I just two things really. One was just thank God that they have, because ultimately I think investors are far too hung up on sector definitions, particularly now if you think about all the occupation and use changes that are going on. I mean, we own a reasonably big chunk of real estate in Holborn. It was built getting on for 200 years ago as housing. It's spent the last 75 years of its life as offices, and it's working its way slowly and gradually back into housing again. And that is without having to knock any of it down and pump concrete into the ground. So I think it's just the reality of the long-term nature of our asset class is that use will change. And I think sometimes the rigid definitions that we have come to use around sectors impairs our ability to manage assets in the long run. And so I think it's fantastic that INREV have made that shift, frankly. The 15-minute city thing, I thought it was interesting that Nick's slide was in French. But, I guess it's probably sort of a hangover from the urban geography course in the mid-1980s, Nick, that you probably pulled that out of your course notes. But
it's actually because it's quite strongly advocated in Paris and by the Parisian planners, which is where we got the diagram.
And so that was exactly my point. I was going to say, if there was one city where I would think that map applies to the way in which they design space, and certainly echoes to our investment experience in Paris, it is that the hub and spoke approach that they're taking in Paris, particularly with reference to laying in the circular tube linkage around Paris now, it probably makes Paris the greatest exponent of that shift in Europe at the moment.
Yeah, it's quite interesting that with Anne Hidalgo bringing that all in when as mayor and all of those things happening, and also I've noticed that there's a lot of focus on that at the moment. There were recently things around looking at the West End of London, particularly, and bringing that in. Because I wonder what people's senses are. I mean, does London really count as a 15-minute city? What are the cities that we think do count as that? And that's also true for the US, of course, Lee, as well.
Because the idea that London is a 15-minute city, for anybody who has to get on the tube or on the train every day, I find mildly amusing.
Well, it's interesting, isn't it? That idea of, is London going to have to develop a little bit towards those things if Alice is right, and that's actually what people are looking for?
Something underpinning both of those questions is something that Nick mentioned earlier, which is both mixed use and the idea of a 15-minute city are always predicated on infrastructure investments. And we're in an environment in which the potential for infrastructure investment may be higher than it has been. And obviously, different regions around the world have very different approaches. Parts of Asia have been investing very effectively in infrastructure for decades. Other areas, Europe and certainly the US, are behind on that. But a bit of a reversal there. And I think the other, since you mentioned London, the idea of being a 15-minute city, one of the reasons that London is not a 15-minute city for most people is the planning regime and how that has caused people living preferences to be outside of the city or inside of the city, but not quite near it. That's echoed. I think there's a changing emphasis and an increasing desire for both the infrastructure investment, but also something, because we have talked a little bit about inequality. That there was a nascent push towards more emphasis on affordable housing and the provision of more housing, but also affordable housing before. But I think that is something that has probably gained momentum and increasing acceptance of the need for affordable housing, even if it is affordable housing in areas that weren't particularly politically popular before. That sentiment may be changing.
It'd be interesting just to also get everybody's view on that concept of impact investing that you alluded to there as well in the presentation, Nick, and you mentioned, Alice, which obviously includes areas like investing in student housing, senior living, healthcare, infrastructure, and some of those public educational establishments, those kinds of things, life sciences. Kim, what's your view on that? Do you see that as a growing theme? I mean, we've talked here about the capital and the pension funds certainly wanting more of that element within their investment strategies.
Oh, undoubtedly. I think it was interesting because we sort of saw it sort of in the run up to the GFC, people starting to get interested in these areas, and then a lot of that fell by the wayside as we rebuilt the damage done by the GFC. But I think this time around, what we're really going to see is that this is going to become very much part of mainstream portfolios. I think there are some challenges in terms of a lot of the specialist REITs have got ahead of the sort of the institutional investment community in investing in a lot of this already. So we're going to find it very competitive, and we're going to find building up the skill sets that allow us to invest in some of these areas a challenge to do quickly. But I think definitely our investor communities are expecting it of us. I think some of it links in very nicely to the ESG themes that Nick highlighted, particularly in terms of thinking about social value and how real estate has to be at the heart of a lot of the social value initiatives. So I think there's definitely an impetus there. But it's not going to be something, we can't pivot portfolios overnight, and it is going to take us a while to build up the skills and to potentially work in partnership as well, because I think there will need to be very active public-private partnerships to develop the infrastructure and the assets that are required going forward.
And that's interesting, because that fits in with the building the recovery aspect of it. And how practical is it? I mean, obviously data centers, a lot of the sort of the industries that Nick was talking about in the presentation, life sciences, data centers, those kinds of things, are all relatively new. And and there's a limit at the moment to how much investment potential there is in them, I think, in terms of standing assets. So how quickly can the industry pivot to that, and what are the ways of doing that?
You covered two things there, and I think there are two compelling trends, and they are interlinked. So one is the pivot towards alternatives, so whether that's data centers, healthcare, infrastructure, sort of social investing. And then there is impact investing as well, and I think it's less clear. So the alternative piece, these are small asset classes, they're relatively niche. You need, for investors like, most institutional investors, you need to find the right operating partner, which is challenging. And you need to build a track record, which is hard to do to attract capital. And then it's a similar story, different story, but similar with impact investing, which is something all investors want. But it could be working with an operating partner, but as Kim said, more likely, a public-private sector relationship. Now, I think that is important because I think increasingly people have been, local authorities have been sort of a bit fed up with people coming in, buying in, selling out, making money. And I think that they would, increasingly want a greater commitment from investors to the broader built environment, whether that's, building schools, helping with infrastructure. And we all know, the things we've done to get through, get planning consent, etc. But the impact thing is really fascinating. And I don't have the answers on what the real estate opportunities are, but we're definitely working on them. And the opportunities ought to be huge, because if you think what real estate is, it's the built environment, the opportunity for real estate investors, developers to improve their lives, to make communities better, it is, it's there, it exists. It's how you capitalize on that. I think it's interesting, so our investors do want, they want to see impact. Now, whether they want to see impact funds or whether they want to see impact across all our strategies, we're unclear on that. Whether you talk to investors, they have a impact bucket, some of them, and some of them have a real estate bucket where they want a certain amount of that to be impact. So it's interesting to see. I think it's going to play out quite rapidly in coming years. The other question is how much money are you allowed to make out of impact investing? It's that sort of awful story. Well, they did an impact fund, but look at them, they paid themselves, this amount of fees. So there's a lot of questions to be asked around the subject, but it is fascinating, and it will be an enduring expectation of our investors that we are making impact to the community.
I think we've also got a unique opportunity here, and sort of picking up a lot of the things we've already talked about these 15-minute cities, the Nick's ideas about love thy neighbourhood. We've got a lot of suburban locations that have been underinvested in, that are really struggling because they no longer have that sort of critical mass of retail at the heart of them. So I think there's ideal opportunities to think about how those centres are renovated and regenerated to really reinsert the heart to local communities, and perhaps offers a lot of those amenities that the 15-minute city talks about that enrich our lives and those of our local communities. And looking at the town centres, there's just a great opportunity there to really invest in them. But it does need partnership, and it needs good planning frameworks. And I think one of the risks we have at the moment is that, if planning's left to be a free-for-all, that actually we won't get the neighbourhood centres that we need. We'll just get a mishmash of residential and accidental retail that won't actually solve the problems.
I think regeneration needs to mean making that place better for the people that are already there and for all parties involved, rather than displacements, which it has in the past. It's been a dirty word, I think, and property developers and owners are guilty of that. And I think that's what really needs to change.
I think that's why I think that the last trend I talked about, a sort of shift in focus at the national level about the way in which we think in the roundabout success, is an important one, because I think if you look at those situations, I'm an out-and-out capitalist, but not to the extent that it should just be a complete free-for-all with no rules. I think that capitalism works best within a framework that is managed, and there are clearly certain situations where we're not going to get a solution to the societal and social and environmental problems that quite clearly exist simply by the free market, but the capitalist market being able to come in and say, right, well, I can see a way to do that and make